Hello students, today we are going to solve a problem on absorption costing and variable costing, that is marginal costing. Okay, so this particular problem is having different information related to 3 years for this particular XYZ company. Okay, so units produced for 3 different years, units sold is also given, unit selling price is given, unit variable manufacturing cost, unit variable and selling and distribution, selling and administration cost is given, annual fixed cost, manufacturing annual fixed cost is 1 lakh, selling and administration fixed cost is 50,000, normal capacity is 1 lakh. Okay, 1 lakh units per annum. Inventory on 1st January 2009 is nil. That means opening stock in the first year is nil. So you are required to prepare an income statement for 3 years individually and collectively under absorption costing and variable costing method, assuming that the actual cost are in conformity with budgeted cost. Okay, here before preparing the income statement under absorption costing or variable costing, first we need to make a note of few important items, or we need to require to calculate the few information. Okay, so few required calculation before income statement. Here stock level for 2009, 10 and 11, and this is collective information for the 3 years 2009 to 2011. Opening stock, so as given in the problem it is only 0. Production during the year is 1 lakh, that is given in the problem. So unit available for sale is 1 lakh, so less sales quantity. So even if the units available is 1 lakh, sales happened only 60,000, which means the closing stock is going to be 40,000. This 40,000 is closing for stock for 2009, opening stock for 2010. Again, production is 80,000, total units available for sale is 1,20,000, then sales quantity is 90,000, so closing stock is 30,000. So 30,000 is opening stock for 2011. Production during the year is 70,000. Total units available for sale is 1 lakh. Sales during the year is 1 lakh, and closing stock is rupees 0. So here opening stock for 2009 to 2011 is 0, and production during the year is 2,50,000. Available units for sale is 2,50,000. Units sold is also 2,50,000. You can add all three columns. Okay, you will get these information. Then, so in this particular problem, it is assumed that under absorbed or over absorbed fixed production overhead is there. If there is any under absorbed or over absorbed fixed production overhead is there, then it is adjusted against the manufacturing cost of goods sold. Okay, now so first we are going to prepare the income statement under absorption costing. The format of this particular income statement is given to you in the classroom app. You can refer to the format to understand the absorption costing income statement, okay, properly understand. Now in the comparative income statement, first we are going to consider under absorption costing, first we are going to consider cost of opening stock. So this cost of opening stock is 0 because the opening stock itself is 0. The cost of opening stock is also going to be 0. We are going to add manufacturing cost of the goods produced. Here variable cost is rupees 2 per unit of output. Okay, so 1 lakh unit output is there, production is there, 1 lakh into 2 lakh. Fixed manufacturing cost is at rupees 1 per unit, So 1 lakh into 1 lakh. Okay, so manufacturing cost of total manufacturing cost of units available sale is going to be 2 lakh plus 1 lakh, that is 3 lakh. So in this particular amount, we are going to reduce the cost of closing stock. The cost of closing stock is going to be 1 lakh 20,000. Students, this is a different page wherein working notes are made. Okay, cost of closing stock is rupees 1,20,000 for 2009. That is rupees 3 lakh. 3 lakh is the total manufacturing cost which is available for sale divided by 1 lakh units which is produced into into 40,000 units. You will get, this is 40,000 days closing stock, you will get 1,20,000. For in the same manner for 2010 is also calculated, which comes to rupees 90,000. Okay, back to the income statement. Here the cost of closing stock, so the calculation is shown to you people in the working note. So 1,20,000, here 90,000. Okay, so manufacturing cost of goods sold is going to be, see here, our goods available and minus closing stock. So this is going to be cost of goods sold, that is 1,80,000. So here under absorption of fixed cost, under absorption or over absorption, this is also calculated in the working note. Okay, so see here, under or over absorbed fixed production overheads are calculated like this. Okay, you can refer while going with the income statement. Now, under absorbed fixed overhead, fixed production overhead is 0. So the manufacturing cost of goods sold is going to be 1,80,000. If there is any under absorption, thus that particular cost is also added. Then the actual cost of, actual manufacturing cost of goods sold is going to be arrived. Okay. In this particular cost, to this particular cost, we also need to add some other cost. Selling and administrative overhead expenses, variable and fixed, that is calculated based on the sales. So 0.5 units per unit sold, that is 60,000 units are sold, 30,000. Fixed 50,000. So cost of sales is going to be 2,60,000 and the sales revenue per unit, sales price is rupees 5, sales revenue is going to be 3 lakh. So the profit for the year is 40,000. Here this particular closing stock is considered in the opening cost of opening stock here. Okay, and all other information are calculated in the same manner, and this closing stock is written down here, and all other information are calculated in the same manner as this particular information is calculated. Okay, and this particular column is related to information for all the 3 years, and this is also calculated in the same manner, or otherwise this can be calculated by adding the first 3 columns. Okay students, so these are the working notes that you should refer for different calculations in the Okay, sorry for the disturbance. These are the working notes that you should refer for different calculations in the comparative income statement. Okay, the next one is comparative income statement under variable costing or marginal costing. Here, the variable costing format is also shared with you people in the classroom app that you can refer. Here, first we need to consider the cost of opening stock and variable expenses less cost of closing stock. Here, cost of opening stock is 0, 80,000, 60,000. So this 80,000 is closing cost of closing stock. Okay, you can consider like this. Then variable manufacturing cost of goods produced is rupees 2 per unit. So here variable cost is considered, that is 2 per unit into 1 lakh unit, 2 lakh. Then here 2 per unit into 80,000 units. Then here 2 per unit into 70,000 units. Okay. Then variable manufacturing cost of units available for sale and available no stock available for sales. In that particular amount we need to subtract the closing stock value. You will get variable manufacturing cost of units sold. Okay. Then variable selling and administrative overheads, that is rupees 30. Then variable cost of sale is rupees 1,50,000. So sales revenue, in the sales revenue, if you reduce the variable cost, you will come to contribution. So 3 lakh minus 1,50,000. So 1,50,000 the contribution. So in 1,50,000 further we need to subtract the fixed cost, that is also 1,00,000. For the first year the profit for the company is going to be 0. Okay. In the same manner for 2010 and 2011 also the calculations are made, and here the cost of opening stock. So cost of opening for 2010 is equals to cost of closing stock for 2009, and cost of opening for 2011 is equal to cost of closing stock is of 2010. And the second calculation. So these calculations are made like this. Okay. You can refer this particular working note to understand these calculations. Okay. For any further queries, you can comment on this particular video, or for any other problems you can directly contact me for assistance. Thank you.